Financials were the biggest laggard in Tuesday's sell-off. Our next guest sees now as the opportunity to buy some of the so-called, quote, trophies on sale. Joining us, Tom Michaud, CEO of KBW. That's the Stifel company. Tom, first of all, let's just talk about that retreat yesterday. What was behind it, and did it worry you at all?
So I think it's a couple of things. The stocks have been very good stocks, and there was a lot of room for profit taking. And so the market probably was looking for a catalyst to take some profits in the bank stocks. And so we've had a pretty material sell-off. We've had 10% pull back on the BKX, and then the regional banks is down about 15%. So I think it's that. And then also, too, there's been a lot of headline reaction. Our view is that the base case outlook for the bank stocks and the bank group hasn't changed. And so we still remain optimistic on what the fundamentals are going to bring. So we think it's a chance to buy the trophies when they're on sale, which I think has always been over my career the best thing to do.
Why are you optimistic?
So first of all, we're not going to have what we had in 23 and 24. The period of the inverted yield curve is over. All the unwinding of the liquidity of COVID, all those things were very challenging for bank fundamentals. We also had a very pro-regulation environment. So our view is at least we think the bank stocks can still do well, even on a soft landing, which was generally what we were thinking earlier this year. We got more optimistic on the economy. I know we've gotten some more cautionary language recently. I think really it's because we had such a big Trump bump after the election that now we're getting a little bit more slower outlook. But still, we think the environment, what we've learned in our channel checks the last couple of weeks is that we still think the economic outlook that's in our models still exists. So our view is that we don't see a credit cycle on the horizon. We continue to see lots of share repurchase. We continue to see deregulation coming and happening as we speak. And we think these are all very good environment for the financial stocks.
What about tariffs? Just trying to think about how that impacts this group in particular. I don't think it was a coincidence that Citigroup was down the most yesterday. How big of a chunk of business is cross-border flow that could be disrupted and harmed if we see tariffs for that one or for the group?
My personal view, it all wraps into the general overall economy. If we get slower growth, we think that's okay. What we don't want to see is a credit cycle. And we just had a big investor conference a couple of weeks ago. There's a competitor conference going on right now. There is nothing on the horizon that makes us worried about a credit cycle. So we think these stocks already embed slow growth in them. And these banks are also repurchasing shares at a faster rate. So as long as the tariffs you speak about don't dramatically change the macroeconomic outlook for GDP growth that tilts us into a recession, we think these stocks are okay. And look, there's a lot of underlying positives happening. Like I said, deregulation. We think M&A is there's no longer a hostile approach to M&A, which could also be very favorable and I think in many ways is necessary.
Tom, are shareholders or investors right to be disappointed that M&A bounce hasn't happened yet?
It seems like, Carl, with that question, you've been in some of our meetings with investors recently. There was a sense that there would be a big splash. The reality is, if you read these proxies about backgrounds to mergers, you'll see it takes months to put together these mergers. I would say rule of thumb is it takes a quarter or two. And what we were hearing from these companies publicly is they wanted to see what happened with the election. So my sense is it's building, okay? And we will see a steady stream if we don't see a big splash. But I want to get to something else, Carl, which is that I know investors were expecting a very big splash on Wall Street. There's a tremendous amount of pent-up demand for investment banking services. There's a lot of private equity liquidity or exiting that is likely to happen. We still believe that's going to happen, but I think the timing is a little bit less certain with the market volatility. So when you think about bank mergers, it's been happening for 30 years, likely to continue to happen. If you think about overall M&A activity, it's a question of timing, but I think there still is a lot of demand for these services coming.